Hi there. Meet John and Mike. Both decided to invest their money using the same plan: 60% in stocks, 15% in real estate, 15% in mutual funds, 10% in gold. After 20 years, John's portfolio grew to around $70,000. Mike's portfolio, however, reached approximately $230,000. So what made the difference? It wasn't luck. It wasn't higher income, and it wasn't a different asset mix. The difference was that Mike understood how macroeconomic forces work and how they affect investments and financial decisions. He adjusted when and where to invest based on economic cycles, interest rates, inflation, and global conditions, while John stayed static. This is called personal financial management, and understanding macroeconomics is crucial, especially if you're in your 20s and just starting your investment journey or looking to manage your finances effectively. Personal finance isn't just about investing and saving. It also includes borrowing, loan repayments, and managing your monthly budget. In this video, we'll explore how macroeconomic factors and economic cycles directly impact your financial decisions and shape your financial future. Imagine a small town. There's a farmer who grows crops, a cafe owner who sells coffee and snacks, a teacher who teaches in a school, and a businessman who runs a clothing shop. Every time something is produced and sold, money changes hands. At the end of the year, the town's mayor adds up the value of all the final goods and services produced in that town. That total value is called GDP, Gross Domestic Product. Every economy moves in cycles. When GDP is growing, it usually means the economy is in an expansion phase. Businesses produce more, people get jobs, incomes rise, and consumers feel confident spending money. During this phase, there are often better opportunities to invest in stocks, businesses, and other assets because prices tend to appreciate over time. On the other hand, when GDP growth slows down or turns negative, the economy moves into contraction. This often signals weaker economic conditions, lower business earnings, reduced consumer spending, and downward pressure on asset prices. Now let's talk about inflation. Inflation plays a very important role in personal finance and investing because it reduces the real value of money. As prices rise, purchasing power falls. This means that even if your income or investment returns increase, they may not actually buy you more in the future. To measure inflation, economists use indicators like the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. When inflation stays high for a long period, central banks usually respond by raising interest rates. Higher interest rates make savings more attractive, but they also make borrowing more expensive. Home loans, car loans, and business loans all become costlier. In inflationary periods, companies with strong pricing power tend to perform better, while long-term bonds often face pressure. As investors, we need to adjust our portfolios by focusing on assets and sectors that can protect purchasing power. As mentioned earlier, every economy moves in cycles: expansion, boom, recession, and recovery. These cycles do not happen automatically. They are largely influenced by how governments and central banks guide the economy. When a government increases spending, especially on infrastructure and development projects, offers tax benefits to businesses, or provides subsidies, it is actively trying to expand the economy. This is known as fiscal policy. At the same time, central banks use monetary policy by controlling interest rates and the supply of money. They may lower interest rates to encourage spending and investment, or raise rates to control inflation. During an expansion phase, businesses grow, profits improve, and employment opportunities increase. This is usually a phase where equity markets and businesses tend to perform well. If during this phase we keep all our money only in savings accounts and avoid investing in businesses or equities, we risk losing opportunity cost, the chance to grow our wealth along with the economy. Understanding fiscal and monetary policies helps us recognize where the economy is heading. Instead of reacting emotionally to news or market movements, we can make smarter personal finance and investment decisions that align with the broader economic cycle. Macroeconomics may sound complex, but when you break it down, it directly affects your income, savings, investments, and overall financial future. Once you understand how GDP, inflation, and government policies work, personal finance becomes much clearer, and your financial decisions become far more confident.